You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert Tim Bratz. Tim is the CEO and founder of CLE Turnkey Real Estate, a real estate investment company that acquires and transforms distressed commercial and apartment buildings into high-performance investment assets for their own portfolio. Working in real estate, Tim has learned how to build a passive business and create a residual income that allows him to live the lifestyle of his choice. He's here to educate and empower others to become financially free through commercial real estate. And I actually had the opportunity to spend some time with Tim a few weeks back at a mastermind that we're both a part of. And I'll tell you that this guy's absolutely killing it. In addition to that, I mean, that's good in itself. But in addition to that, he's just an all-around great guy. So I'm excited to get onto the show with Tim here today. But before we do, here's a quick word from our show sponsor, Sunrise Capital Investors. Hey guys, Kevin Buck here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. All right, guys. Now, without further ado, I'd like to welcome our guest for today's show, Tim Bratz. Tim, what's the word, my friend?
Kevin, man, appreciate you having me here, dude. Really respect the heck out of you and awesome. Really excited to be here.
Yeah, I'm excited to have you here, man. So as I told you before we started recording, I don't drink coffee that often, but you're a man of high energy. Like you're just always like zooming around. Like
always.
In fact, I was going to say your hair's on fire, but I know that you go for the smooth look. So maybe that's what happened. You just burned all the hair off, right?
Burned it off, man.
Slowing you down. So in any event, I'm excited to have you on here, but excited to dig into your business a little bit and share with our listeners a little bit of your background and your story and just really give them the path that you've taken, up until today. So if you would, maybe take a few minutes for those that aren't familiar with you, don't know your story and your background. Tell us a little bit about how you got into real estate. And then in addition to that, what you guys do over there at CLE Turnkey.
I'm 33 years old and got involved in real estate when the market was booming. So 2003 to 2007, I was in college and everybody said, hey, if you want to get rich, if you want to build wealth, then you should get involved in real estate. And that's what motivated me when I was 20, 21 years old. I'm from Cleveland, Ohio originally, but my brother lived out in New York and he said, hey man, why don't you come and live with me and you got a free place to stay and find a job. So I ended up getting my real estate license and becoming a real estate agent for commercial real estate in New York City. Man, I remember brokering just a small 400 square foot space in Greenwich Village area. It was Thompson and Bleecker Street. It was 400 square feet. And the landlord leased it for $10,000 per month.
Wow.
And that was and there were 4% escalations every single year. And it was, I think, a 12 or 15 year lease. So I remember doing the math on this thing. And I'm like, this landlord is going to make almost $2 million from something he did one time 12 years ago. And I'm like, man, I'm on the wrong side of the coin. Instead of brokering real estate, I need to be owning real estate. So it was a tough winter and I decided to move down to Charleston, South Carolina. And at the age of 23, I went through that whole analysis paralysis phase and went to all the guru seminars and read all the books and tried to do a lot of personal development stuff. And it was really good. But after like 6 months of doing that, I realized that I wasn't going to learn how to do real estate unless I just like jumped in the water. So learn how to swim that way. This is right after the market tanked. So this is like 2009 now. And the cheapest house on the entire MLS was $25,000 in Charleston, South Carolina. And it was dumpy. It was in the hood. But I didn't have any money. So I had like a few $1,000s, probably $8-9 saved up from my time up in New York City. And then I had this credit card with about a $3,000 limit on it. And mind you, I'm 23 years old. I don't have a mortgage. I don't have a car payment, like anything like that. And so I have zero credit. Called my credit card company. I read about it in one of these books that you can call up a credit card company and ask for an increased limit. So called my credit card company. I was like, I'm about to make a big purchase. I need you guys to increase my limit today. Like, what can you do right now? And she's like, what are you buying? And this and that. And like, how much do you need? And I was like, I need $100,000 credit card limit. And she's like, absolutely not. I was like, well, what can you do right now for me? And they said, they'll give me 15,000, 1.5. So I was like, fine. I act like I'm all upset, but I'm like, yes. So they increased my limit. They sent me over some balance transfer checks. I ended up going to closing. I made an offer on that property, went back and forth. I ended up getting it for $14,000 and went to closing with a $15,000 balance transfer check from my credit card company. My gosh. And the attorney's like, what the hell am I supposed to do with this? He goes, dude, you need to put this in your account and then bring me a bank check. Yeah. I was like, I don't know, man. Hey, this is my first deal. So ended up buying it. I did all the work. I changed out the carpet, the fixtures, painted the whole place, landscaped the whole place. And again, man, I didn't know how to sell either. And so I just printed out a bunch of flyers and delivered them and held an open house one weekend. And one of the neighbors came by and was like, hey, I was all into it for probably like $18,000-$19,000. And the neighbor said they'd buy it for $33,000. And so I sold the property. I'm a punk 23-year-old kid at the time. Never did a deal in the worst housing market in 80 years. And, got the biggest check of my entire life, about $13,000 or $14,000 profit. So I was all fired up. I did it again, got involved in like wholesaling, went down that path for a while. I think a lot of people get involved in real estate because of the allure of passive income, of residual income. And then we all get stuck in this transactional phase of trading our time for money and thinking we have to go and stockpile a bunch of our own cash in order to go and have that to go buy these passive residual income producing assets. And I guess that's the path that I went down. And so I did a lot of flips. I did a lot of turnkey houses. That's why my company's Cleveland Turnkey Real Estate. We flipped probably, I don't know, 100 houses a year for a few years, and then realized that I could just take my private money, and instead of having them lend money to me on single family houses to flip, I could just marry them up with bank financing and go and buy some apartment buildings. And so, I partnered with some other private money people. They put up a couple bucks. I built up a portfolio of about 150 units, and then that partnership went south. So in case you've ever had a bad partnership, and people are trying to weigh who brings what value to the table, and that can go south, especially in bad times, and God forbid you make money, could get even worse. So
I want to talk about that real quick before we go on, if you wouldn't mind, because I think that's an important topic. Hopefully you're okay with discussing this. But I feel like everyone that when they get their start in real estate, a lot of people are fearful. They don't know what they don't know at that point in time. We've all been there, right? And they go to a boot camp, they go to a seminar, and they meet another person that's also fearful, right? And for whatever reason, everyone's drawn to the idea of a partnership. And don't get me wrong, I'm in a partnership today. It's great. I've been in many other partnerships. I've also been in some challenging partnerships. But in any event, at some point in time, most people either consider it or end up in a partnership. And so they go good, they go bad, and sometimes they're just neutral, right? Let's talk about the one that went bad, and what happened there. What would you have done differently? Was it something that you saw at the outset that maybe you shouldn't have stepped into that partnership, or was it something that completely blindsided you? And then how'd you recover from it?
Good question. So this started out, this is when I was like 27 years old. So I'd done a few deals, and I had some guys that came up to me and said, hey, listen, we got money, a bunch of cash, but we don't have the time and we don't have maybe the knowledge to go and invest in real estate. What if we put up the cash? It was two brothers. What if we put up the cash, you do all the work, and we'll split the profit? So initially it was 50-50. And then right before we actually organized it, they're like, well, there's two of us and one of you, let's do 67-33. And I was like, all right, whatever. But I'm 27 years old. There wasn't a lot of opportunity for me at the time. There wasn't a lot of people that were willing to bring $1 million plus to the table to go and lend to some 27-year-old kid who had done a handful of deals, but it wasn't like super successful by any means. So they put the money up, and it was a fixed amount of money for about 2 years, 3 years, where I just took that money and I kept on rolling it. So we bought some high-end flips, low-end flips, some single-family rentals, and then I fell into an 8-unit apartment building that I just couldn't pass up. The price was smoke and deal. And after that year, I realized, I looked back at my business and reflected on where was I making all the money, and it was in flipping apartment buildings. So I ended up selling all the retail flips, and we just focused on buying apartment buildings. And I bought another 8-unit, and then I bought a 14-unit, and then I bought a 23-unit, and then a 31-unit, and went down this path where we picked up about, using that $1 million, I turned it into about $3.5 million in probably 24 to 30 months. And we just kept on putting everything back in. And there were a couple of things that happened during that time where, I was supposed to take a salary. It wasn't a big salary. It was a couple $1,000s a month. And that got kind of swept away from me after about 12 months of doing it. So that didn't taste well. And then we just went down this path of our biggest building, this is my crown jewel of apartment buildings in that portfolio. It ended up burning down. One of the tenants got mad and lit a fire. The whole thing burned down. So that created some additional stress where we didn't have the cash flow coming in. We went through a 3-year lawsuit with the insurance company on that and got paid out less than half of what we should have. So, there were a bunch of catalysts. And then what happened was we sold some property, had over $1 million in a 1031 exchange, was going into buy a 100-unit portfolio in an awesome area, smoke and deal. When I went and did that, I'm bankable. I got 800 plus credit score, and at the time I didn't have a ton of assets or anything, but good credit and good background. And my business partners, they had gotten in some trouble about 15, 20 years ago, had some bad things on their credit where they were just not bankable. Literally no bank would touch them.
Wow.
And so it went down this path of hey, well, let's just put it in your name, and then we'll transfer it back to our name, and we won't let anything bad happen to you. And it was just one of these things where it wasn't a good situation. And now I have to bring more to the table. They were supposed to bring all the money. I was supposed to just do the work. And now I'm bringing the money and doing the work and doing all this other stuff. And so we kind of butted heads, and it ended up being a really tough breakup. For 2 weeks, we kind of lawyered up, and it was super stressful, probably the most stressful 2 weeks of my entire life. And then eventually we just got level-headed, and we're like, hey, we're just going to throw a bunch of money. The only people getting rich in this situation is going to be the attorneys. Let's sit down. Let's figure out a way to just liquidate the portfolio and move forward. So I have a decent relationship with them still. We don't do any business together anymore, but just say what's up once in a while. It was a setback at the time, but some setbacks are really setups for better things to come. And by having that off my plate, I was then able to start a new business, CLE Turnkey Real Estate, bring on a team. And, that's when we started flipping about 100 houses a year for a couple of years. Then I got passively invested into a couple apartment buildings with some joint venture partners down in Georgia. And about 12 months ago, man, I looked at my life and I looked at where was I spending my time and where was I building my wealth. And literally 90% of my wealth had come from apartment buildings, but it was only 10% of my time. And I thought, what if I dedicated all my resources from the turnkey business of flipping 100 houses a year, and we just focused on buying apartment buildings? And over the past 12, 15 months, that's all we've been doing. So I took my acquisition guy, I said, stop looking at single family, just start looking at apartment buildings. I took my disposition guy, I said, stop selling single family, start managing apartment buildings. My COO, instead of doing single family, we're doing commercial. My project manager, instead of renovating houses, we're going to be renovating apartment buildings. And so it was a pretty easy pivot for us to do that. And in the past 12 months, man, it's amazing, like when you focus like that and put that out into the universe and how the universe responds to you. I built a portfolio. I went from about 350 units last summer, and right now I'm at 1,359 units. So I picked up over 1,000 apartments in the past 12 months, and I have another 730 units under contract to buy before the end of the year. So I'll be north of 2,000 units in less than 18 months of making that decision.
Boom. I love it, man. That's awesome. That's an awesome story. So you guys completely 100% transitioned away from residential. I mean, are you doing any turnkey anymore whatsoever? Do you have any residential investments? You're 100% away from that business.
So the only residential investments I have are, I own some vacation rentals down in your neck of the woods in Kissimmee, Florida. And I was looking in Tampa and stuff, but yeah, so I own a couple of vacation rentals down there, just trying to test out a different asset class.
Yep.
And you know what the market's like. The market's really hot right now. People say you can't find deals anywhere. And sometimes we succumb to that. And we're like, oh, well, maybe we should look at some different asset classes. Maybe I should look at office. Maybe I should look at retail. Maybe I should look at vacation rentals or land development or all this other stuff. And every time I veered away from doing what my core competency is, which is apartment buildings, I end up going through this learning curve that's just a kick in the teeth over and over and over again. And so, although the vacation rentals are performing, they're okay. It's a huge time suck for my team versus going and buying an apartment building, which we already have dialed in, queued up, there's resources for it. I'll give you another example. Like I bought in a C-class area. I bought a 44 unit in a C-class area because I had some money sitting aside. I'm not a C-class area buyer. I buy in B-class and A-class areas, but I buy distressed properties in those areas where we can force the appreciation. And I bought a C-class. Been a total kick in the teeth, man. I'm dealing with it. Huge time suck for my business. I bought a mountain because I thought I'd sound cool and I could put it on social media and stuff. So I bought this.
We talked about that. Yeah.
Yeah. So I bought this 270 acre mountain in the Poconos, right on the border of Pennsylvania and New York, thinking I'd develop it or turn it into something and like wholesale it off and make a quick $1 million. And that was last summer, beginning of last summer. I still have it 15, 18 months later. And now I'm fire sailing it. I might make $100,000 on it. And it's been a huge time suck for me. So like the power of focus, just doing one thing and just being a ninja at that one thing is so incredibly powerful.
Yeah, I mean, the shiny objects are like kryptonite to us entrepreneurs. And literally, it sounds like you have multiple forms of kryptonite going on in your business that you need to chop out.
Yeah, so that's what I'm doing
with the mountain. Starting with the mountain.
I'm cutting, I'm fire sailing the mountain. I just fire sailed. Like we had one last flip that was in our portfolio from last year. And I cut the price by $75,000 and I took a loss of like 30 G's on it just because I wanted it out of our portfolio. I'm like, why are we doing this? This doesn't meet our long-term goals. Our long-term goals is to pick up 10,000 units in the next 5 years, So like, why are we spending time on anything other than that one single goal? And it confuses the team too. When you start doing other stuff and you look at like people want predictable, know what's coming, know what the vision is. And we start throwing all these different wrenches into the wheel. It just
well, I think what you need to do is like, your core competency today is multifamily. Focus on multifamily. The earnings that you make from that multifamily, if you want to go dabble in vacation rentals or buying mountains and subdividing them, go team up, go invest with the team that's their focus. That's their core.
Exactly. Who knows that?
The guy that's developed 30 mountains over his lifespan. Like go invest with that guy. He knows what he's doing. He knows how to time that marketplace, and knows the cycle and how it applies to that particular niche. Go work with him. Put your money with them. Let them do what they're good at, which are mountains, and you focus what you're good at, which is multifamily. So it's hard.
We talked about this last week, man. If I ever got mobile home parks, I'd be calling you up.
Yeah. Well, what makes it really hard is, there's so much information out there, more so today than there was ever before in the past. With podcasts, with, masterminds. We were just at a mastermind with, some of the top rock stars in the real estate industry. And, there's student housing guys there. There's assisted living guys there. There's self-storage guys there. There's a ton of single family guys there. But there's guys that are killing it in every aspect of business. And, it's hard not to, have that shiny object be like shining in your eye and say, I want to touch that a little bit. We can make money in that too, at the same time. And it's really hard, right? It's every different asset class is a completely different business. Although they have similarities, they're a completely different business, and you've got to put 100% effort into it if you're going to make any money at it and be successful at it. So, and that's hard to do simultaneously, 2 things or 3 things all at once. So I want to talk about some of the value add stuff you guys are working on today. So you guys focus on at least some of the projects that we were talking about that you recently got involved in. They're very heavy value add plays. And so more importantly, I want to talk about maybe the 5 apartment portfolio that you purchased. I think it was all 5 are in Georgia, different markets in Georgia. Very big value add play. I think your baseline price on that was right around $10 million, but you've got about that same amount into rehab, getting these things back up and running. Can you speak to that deal a little bit? Just, that would scare most people away. They'd be hiding in their closets in the shadows like, no, don't bring me that thing. Like, I like value add, but that scares the crap out of me. Talk to me about that. What excites you about it, and how you guys are going to turn that into an opportunity?
So that's why we were able to get it, because it did scare most people away. We're in a great economy right now. Because the economy is so good, everybody thinks they can be a real estate investor. So there's a lot of money that's out there that people are trying to put into apartment buildings and multifamily space. And all the stuff that's turnkey, that's like totally stabilized, you're going to be paying a premium for it. We're real estate investors. We don't pay retail price. We need wholesale pricing, regardless of if it's stabilized or not. We needed a deep enough discount to make sure we can, force that appreciation and create some equity there. So on some of these bigger apartment buildings, it's very difficult. Like all the real estate trusts and all the hedge funds and the family offices, they all play in the 100 units or bigger realm. So most of my buildings have been typically 30 to 80, 30 to 100 units. And we're kind of right in that pocket. 60 to 85 is kind of my bread and butter, because it's too big for the small guys and it's too small for the big guys. This portfolio came across our table because it was very distressed. It was only 60% occupied. And the financing that you have to put in place on that, you can't get traditional Fannie Freddie agency type financing. Even most banks will not finance something that's that distressed. So you essentially need to go to a debt fund or some other type of like hard money provider in order to be able to finance something like that. And you need to be a hell of an operator in order to be approved for something like that too. You need to have a hell of a track record. So my joint venture partner down in Georgia, we just did 200 units that were very, very similar, actually in the same town. And we made an offer on this portfolio of 730 units earlier in part of the year. And we didn't win the bid. We were a lower bid, and somebody else came in and bid many millions of dollars more than what we did. The issue was they couldn't get approved, and they couldn't get the financing lined up. They didn't have the resources. They didn't have the track record. And because of it, they dragged the seller through the mud for about 6-8 months. So when it comes back in the market, we came in and we realized that the seller's motivation was they wanted this thing off their books. They wanted somebody who was that confident in their ability to close. And so we went in low again, but we put up $250,000 of earnest money hard from day one.
Wow.
In order to posture up in a way that nobody else would posture up, to say we are that confident in our ability to close on this thing, but we need a discount. So that was the trade-off, and they ended up passing on many other offers in order to go with us because we were that confident in our ability to close. So we ended up closing on that. My joint venture partner, I don't invest anywhere where I don't have like a joint venture boots on the ground partner. And my partner down there, he's probably one of the best operators. He's not very like vocal or involved in a lot of the masterminds and like the real estate world like we are, but he's like a phenomenal operator, knows construction inside and out, has built up ground up developments, multi-million dollar homes that he's built up in Greenwich, Connecticut for all these investment bankers. And so like he knows his stuff inside and out. He knows how to deal with contractors. He knows how to negotiate with suppliers and vendors. And yeah, I mean, it's a big value add. We're dropping over $700,000 a month for the next 15 months in improvements in this thing. So there's constant money going out, but it's just big ticket items. Like to do the roofs was like almost $1 million. but it was pretty easy to negotiate that whole thing and then line it all up. And then we just slammed out this roof and then this roof and then this roof and then that roof, So people get very, oh my gosh, it's a $10 million renovation. You're dropping $700,000 a month. That's whatever, $23,000 a day in renovations. Yeah, but it's the same as if you were renovating a single family house. You're just multiplying it by 700 units, So we just need 700 kitchens. We need 700 bathrooms. We need 700 roofs. We need, that's how I look at it. And it's just a lot more, it's a lot easier to take a bite off of that.
Well, personally speaking, I think the riskier part of that endeavor of like such a large rehab is not being able to stick on timeline, right? That you got to rely on your team that's there on the ground. You got to rely on the management company that's working with you on that project, because if what was projected to take 6 or 8 months takes 12 or 14, it's a big deal, right? Especially when you got very expensive money, you got a lot of holding costs as this project moves forward. And so I think that in my mind, like that's the bigger risk. It's not necessarily, the actual size of the rehab dollars themselves. It's just staying within that projected timeline. It's much easier to do that if it's a $1 million rehab versus a $10 or $14 million rehab. And there's a lot more unexpected that pop up. And I'm sure you guys have already planned for those. But in any event, the question I have about that deal, obviously it's 60% occupied. So it was distressed, lots of rehab that's needed. So lots of deferred maintenance on these properties. But in addition to just the deferred maintenance and the overall physical condition of the properties, is there a lot of rebranding that has to take place? I mean, do these properties have bad reputations in the marketplace, or whether it's, drugs, sex, rock and roll, or, shootings or anything like that? I mean, is that something that you guys are also going to have to contend with?
Definitely. Yeah. And these guys, the previous owners were known as slumlords in the area. They got blacklisted because so we're in 2 towns in Georgia, both are military towns, and they got blacklisted by the military in the one. And
wow.
There's no subsidies for the military. So now that we came in, we rejuvenated those relationships and talked to them, said, hey, here's everything that we're doing. Here's our track record. Go look at our other properties other around Georgia. We're phenomenal landlords. We take care of the properties. Everything's clean, safe, functional, aesthetically pleasing. We want to make sure that we're providing great housing options for the tenants. So we've already created those relationships with the local military bases. So that's good. Obviously, yes, we rebrand it. We don't want the same Google page and the same Google reviews. So we're going to put a new name on there, new address on there, and we're doing all that. But it's been a big undertaking, but people are seeing the value. It's a small town, so people see how much value we're bringing, and the word spreads pretty quickly. I mean, we're on track. Like, we thought it was going to be an 18 to 24 month process. We're on track to knock out all 5 buildings in 15 to 18 months.
Wow.
Maybe less, probably more like 12. Well, from when we bought it, 15 months.
And then like total time frame for stabilization, that the renovations and then actually getting that occupancy up. I mean, what's your projections on that? Yeah,
so that's included in that. So we're gonna actually knock out all the construction in less than 12 months on all the buildings. And again, we just renovated 200 units in the same town.
Gotcha.
So I had 2 other apartment buildings, a 60 unit and a 134 unit that we just finished renovating. And we're able to take those exact same crews, those exact same suppliers and vendors and everything, and just shift them across the street to these other buildings. And so it's and they know exactly what our expectations are. They know exactly what type of finishes and everything that we want. And so it's been a pretty seamless transition, and we're able to just get in there and knock out all this stuff really, really quick. So from the construction standpoint, the idea is we have 5 buildings. What's nice is that because we have 5 buildings, we don't have to wait for all of them to be stabilized in order to start refinancing. So we'll have 3 of the buildings fully renovated, fully occupied, 90+% occupancy. So that way we can renovate or refinance those in less than 12 or right around the 12-month mark.
Got it.
3 of those buildings will be done by May, June of next year. And then the 4th one will probably be like July, August. And then the last one will probably be August, September. So we'll have them all slammed out and fully occupied. They're, especially with like all the investment that's going into the military and stuff through the government right now. The one military town just brought on 1,200 new people from across the country and brought in 12. So they need housing for 1,200 more units. And then in the other one, it's something like I don't even know. It's like 3,000 or something crazy. So, or they have a waiting list of over 1,000 people that they're waiting for housing. So as soon as we get these things filled up, we develop these relationships with the local military bases where they're just going to start filling up all of our units for us. So we should. I
was going to ask you, what's the average occupancy in those 2 markets for multifamily? Is it like 98% or higher?
Here's the thing. You can go to New York City and be in downtown Manhattan. And if you run the property, poorly operate the property, if it's
Fair
a
enough.
dumpy place, if it's not safe, you're going to have low occupancy. You come in even into like a tertiary market, which is mostly where we buy, and you provide clean, safe, functional housing. If you respond, like 99% of all landlord issues are eliminated by doing two things. One is taking care of the property, and two is screening your tenants. So we do both of those things. We do them both very well. Do you get a crazy tenant once in a while? Yes, absolutely. That happens. Does things get shifted and people go nuts and all that stuff? Yeah, absolutely. That happens. But or somebody slipped through the cracks and not as qualified, and they start bringing in their boyfriend who, has a bunch of drug problems and we have to deal with that. Yeah, absolutely. But for the most part, 99% of all of our issues are eliminated, and we keep above 90% occupancy. We're actually probably around 94% occupancy in all of our properties.
That's fantastic. Yeah. Those random crazy stories are what make, they add some excitement to this business on a regular basis. So I actually enjoy them.
Yeah.
Well, fantastic. So I want to talk to you a little bit about the market today. I mean, you guys are in those two markets in Georgia, but generally speaking, it's kind of hard to paint a broad brushstroke across the entire country, but just generally speaking, two things. What excites you about the real estate marketplace today from an investor's perspective? And then on the flip side of that, what scares you?
Great questions. So although most of my holdings are in Georgia, probably, 70% of my holdings are in Georgia. I'm in Atlanta. I'm in Savannah. I'm in a couple military towns outside of Atlanta, a couple hours south of Atlanta. I have vacation rentals in Florida. I own a couple hundred units up here in Cleveland, Ohio. I also own buildings in Texas, and I own some properties in Charleston, South Carolina still. So I'm in 5 different states owning properties and being able to take a look at some of that. What's cool about the housing market right now is the availability of funding. 5 years ago, very, very difficult to raise money on real estate. Everybody was scared. Everybody was very speculative on where it would be going. It's very easy to raise money right now. I mean, the stock market's up and down like crazy. Bitcoin obviously didn't turn out to be what a lot of people thought it would be last year. And people want their money in something that's sticky, something that's tangible, something that will create predictable revenue and predictable returns for them. So it's very easy to raise money right now for real estate. And the financing options are awesome too. Obviously, interest rates are very low. On my commercial stuff, you go to a typical bank and it's a 5-year loan term with a 20, 25-year amortization. All these agency loans like the Freddies and Fannie Mays they're doing a 10-year term, maybe even 12, 15 years in some cases with a full 30-year amortization. So my intent, I don't flip apartment buildings like a lot of other people do, like a lot of other syndicators do. I go in, I buy an apartment building. If I'm putting that much work into it, I want to hold this thing for long-term wealth building. I want the residual income. I want the passive income. Yeah. So when we renovate, rent, and then stabilize these units, I put long-term financing in place, and then we hang on to this thing for the next 10, 12 years because I know it's not going to need any of those big mechanical roof, windows, foundation, concrete. I know I'm not going to need to put any of that stuff in for probably 20 or 25 years. So I want to hang on to this thing for as long as possible. I'll take a look at what the economy looks like 10 years from now and either refinance again and hang on to these things for another 5, 7, 10 years, or I'll turn around, sell, and roll into something bigger, something nicer, whatever. We stick mostly to B class, like I said, areas, and kind of goes into like the second part of what happens when the economy is good. Everybody can afford B class areas. When the economy shifts, which that's going to happen. It's definitely coming. All those A class renters move into B class areas. So you still have a really high occupancy in these B class towns. I still look for like some economic indicators and make sure it's a safe area, make sure the schools are good, make sure that there's an economic anchor, whether that's a military base, whether that's a major business, whether it's a hospital or something along those lines. So we still look for an anchor of some sort like that, a school, to make sure that there will always be jobs. There will always be ancillary positions and roles and people that are going to have to live in apartments. As far as what scares me about the market, there's a lot of people that are getting involved in real estate that don't belong in real estate. Most of my properties that I buy right now are people who got involved, smart entrepreneurs, really successful in whatever they're doing, not realizing that there's a learning curve in apartment buildings. I bought this 700 unit portfolio from a couple of multimillionaire stockbrokers out of New York. And they don't pay attention. They don't have any boots on the ground. They didn't pay attention to the management company. They don't know how to be a good landlord and provide good housing. We were able to come in and we bought those for pennies on the dollar. I actually bought a 60 unit building across the street from a guy who had a cabinet and granite fabricating company. This guy deals with contractors and real estate investors every single day. Hey, I could probably get involved in real estate. So he goes and buys a 60 unit apartment building, gets punched in the mouth, takes his eye off the ball in his primary business, still is going through a learning curve in the apartment building, loses everything. And then somebody who knows what they're doing, like me, swoops in and buys it for pennies on the dollar.
Yep. I want to back up. I want to talk about the two, multi-million-dollar or millionaire stockbrokers up in New York that own that 5 apartment portfolio that you purchased there in Georgia. I'm assuming they probably had a local management company overseeing this asset. I want to better understand. I'm sure you've probably dug into this. You know a lot more of the story. What really went wrong there? So, assuming they had a local management company overseeing this asset, was it more from an asset management standpoint on their side? They just weren't giving good direction to this management company, or was it just that they chose the wrong management company for this particular project, or was it a combination of everything of the above?
I think it's both. Yeah, I think it's a combination of everything. They didn't interview management companies. The management company, was just nickel and diming them. Okay. And then at the same time, they weren't willing to reinvest in their asset. The other class of people that I buy a lot of apartment buildings from are mom and pop owners who've owned the property for 20 or 30 years. They live off of 100% of the cash flow. Yep. They don't put any more money back into the property to make sure it's stable and safe and functional. And so eventually when you suck all the money out of a property for that long of a time, it needs so much work and they're not capable of getting the financing for it. Like they have no other option but to sell the property. So, it was a combination of both bad management, bad interviewing of management companies that were nickel and diming them the whole time. And then at the same time, they weren't willing to invest in the project themselves. So if the management company did ask for money, I think they knew they were getting screwed by the management company. They didn't want to give them any more money. And then so the management company couldn't do anything. And when units went vacant, they have even less revenue to then put back into the property and make improvements. So it was just a downward spiral. And you let that go for a couple of years and that's what happens.
Yeah, it gets out of control pretty quickly, especially with that many units.
Right. And the market was good. These guys are stockbrokers. The market's been going gangbusters for the past couple of years. Mm-hmm. So they're making millions up there versus making, $1 million a year or something from this apartment portfolio. Yeah. They were spending time where a majority of their money was coming from. Mm-hmm. So they just didn't even pay attention.
Yeah. I want to talk a little bit about risk mitigation. Like this particular deal, you guys get a bridge loan in place, which you're going to refinance out of here in the coming, 12 to 18 or 18 months or so. You said when the project's finished, you're going to start refinancing these buildings. I'm assuming that you're going to get agency debt. You're going to do one building at a time, meaning like one loan per building, or are you going to actually cross collateralize them and package them together?
Yeah, we're going to try to do one loan per building.
Okay. What do you guys do as far as risk mitigation factors on the front side when you're underwriting a property? Obviously, no one can tell the future. Assuming that your plan A doesn't go as planned, do you put plan B and plan C in place? And if so, how do you do that? For example, I know on our side, what we do buy many different mobile home park properties that today would not qualify for non-recourse debt. We have a typical turnaround phase, just like you do for these properties, to get them turned around, stabilized so that we can get non-recourse debt put in place. But we also make the assumption that the market could shift in a couple of years where that might not be available, or the rates might be higher. Let's say we got a 5-year note and we're going to have to, refinance before that 5 years is up. And let's say come that point in time, rates are 3 points higher than what they are today. What does that look like? Can that deal support? So we'll run multiple different financial models to make sure that we can pay our investors, make sure that we can pay ourselves, make sure that the property can be self-sustaining, even if the rates jump up, even if we can't do a cash out refinance when that was originally part of our initial plan. So what do you guys do on your side to mitigate those future risks?
A lot of the same stuff. Okay. So we expect interest rates to go up. I don't think they're going to go 3 points by next year.
And that's a little extreme, yeah.
but it's a real situation that could happen.
Yeah.
I think we're pretty safe until the re-election comes up. Yeah. And then when there's a lot of speculation in 2020 and, are they going to bring in a Democrat? Is Trump going to get reelected? Like, what is all that stuff going to look like? I think that's when a lot of the uncertainty comes in, where people get spooked and banks get spooked and they tighten up their lending limits. They increase their interest rates a little bit to reduce their risk. And so because we're refinancing all these things next year, we feel pretty comfortable. Mm-hmm. Rates have gone up a little bit over the past year and a half. So we are expecting, we're underwriting for an extra 0.5 point rates to go up by next year. If they don't go up, and we're underwriting for a lower loan to value as well. Yeah. So instead of maybe underwriting for an 80% LTV, we'll underwrite for a 75% LTV. Mm-hmm. The age old adage is location, location, location in real estate, right? I believe that. I actually think it's number 2, though. I think wholesale is number 1. Regardless of where you buy, as long as you're buying at a deep enough discount, I think you can make money in any part of real estate. Like I know people who just invest in the hood and they're buying houses for a couple $1,000s and they're flipping them and making a few $1,000s on those. So I think you can make money regardless of the location as long as you're always buying at a deep discount at a wholesale price.
Yep.
We try to kill every single deal. I don't go in and try to force a deal to happen. I try to kill it. If I can't kill it, then I know that it's probably a deal. So, we'll underwrite it like this one. We're all into this with debt service, with soft costs, holding costs, all that stuff. We'll be all into that project for around $24 million. And today, like we just refinanced those 200 units across the street. And if the lending environment does not change over the next 12 months, that portfolio will be worth $45 to $48 million. So there's a boatload of equity in there. If the market does shift, if we get a lower LTV, if the interest rate goes up, and let's say property values drop by 20%, I'm still able to go in and refinance and put long-term debt in place and pay back all my investors and still take a couple $1 million off the table from refi proceeds. So we're very, very conservative in that aspect. And from a risk mitigation standpoint, if I can't with adding an extra half a point onto the deal and going at a lower LTV, if I can't refinance out and pay back all my investors and all the soft costs and the hard costs of that project, then I won't do the deal. So essentially, I need, just like single family, you need to be all in for like 65 cents on the dollar. Yep. That's about what we average in my multifamily stuff, maybe 65 to 70 cents on the dollar. So that way, worst case scenario, I know that I'll be able to refinance even at a 70% LTV and cover all those costs, and in order to do that refinance, closing costs and everything, and then pull all of our money off the table for our investors.
I love it. And I think that's where the irrational behavior is coming into play with a lot of folks nowadays, is that whole, the model that we used to use for single family is all in for 65 cents on a dollar. You kind of saw it creep up to 70 and then 75. And I was just talking to someone at the mastermind we're at, and I whatever market they were in, I couldn't remember, but I was kind of asking them what their threshold is. And they're like 82%. I'm like, oh my gosh. Like, yeah, like that's literally playing hot potatoes, right? Yeah. Musical chairs, like, don't be left out without a chair.
Dude, when you start seeing that happen, and you start, you go get your haircut, or you go talk to like your waitress, and they're talking to you about how they're buying real estate, that's when it's time to like sell or just be super conservative, super careful. Yeah. So like, we're still able to find deals because we go direct to the seller. We're not buying through brokers.
We do too.
Typically, the stuff that brokers see, if you see it through a broker, it's already been picked over and passed on by the top 20, 30 investors in town. It's usually way overpriced, so we don't buy anything. We go direct to the seller. We're doing direct mail. We're outbound phone calls, driving for dollars, dialing for dollars, like all those kinds of things that other people aren't willing to do, so that way we can get the deals that other people aren't able to find.
Yep. I feel you there, brother. So, yeah, we do the same thing. Yeah. You can't, you guys, in this environment, you can't rely on brokers. I love brokers. We just, closed on a couple deals last week that came through, one that came through a broker. And then we got great broker relationships, but I was just having this conversation yesterday with a broker. They're probably one of the leaders in our space from the brokerage side. And he called me yesterday. He was up in New York at one of our, he was up there looking at a listing they're bringing to market. And he was kind of driving the marketplace there. And he drove through, we have a really nice community up in the Buffalo area. And he was in it. And he called. He's like, hey, I just got done driving through this community here. And he's like, this is gorgeous. He's like, let me know when you want to sell it, And anyway, but we got to talk, and we were making a joke. I'm like, you can sell my properties all day long. We're not a seller, but when we are a seller, you can sell them all day long, James, because you're going to bring a 5 cap buyer. I can't. Right. I wish we could do transactions the other way, where I'm buying something from you, but I just can't pay your prices, because there's always someone out there willing to pay more. And so we always have this little back and forth jab at each other. And it's like, man, I'd love to buy your deals. He sends them to me, but I'm like, this is a joke. I can't make money buying this at a 5 cap. There's not even any value add left there, and there's a lot of risk associated with it. So we try to take the roundabout approach like you do, slice out that broker so that they don't take it to the mass marketplace. Because again, there's always someone out there willing to either pay more than you or has a lower cost of capital than you that can always, up the price and make the deal work for them that wouldn't work for you and I. So,
I mean, there's hedge funds and family offices that they have so much money. They just need to put it somewhere and get any sort of return on it. Yeah. And I'm not that guy. I need to go find value add properties where I can force appreciation and create that sweat equity in order to find good deals. So I'm still buying. Obviously, I picked up a boatload of properties in the past 12 months. I'm still buying for the next 12, 15 months, 18 months, as long as the lending environment maintains how it is. There's going to be some shifts that you're going to have to take a look at and, make some shifts in your business and pivot a little bit as the environment changes. But, we're able to make money in any climate. Right now, what my goal is to build up a big enough balance sheet so that way when the market does shift and nobody else, cleans out all these low-level investors and people who are overpaying for stuff, I'm able to go in and, I got a balance sheet, I have the cash flow, I'm very liquid, and I'm one of the only bankable people who can then go in and buy all these other properties. If you're buying at a 5 cap and you're buying luxury at a 5% cap rate, what's going to happen when the interest rate goes up by 1.5 points? You're not going to be able to refinance in 5-6 years. You're not going to be able to sell it in 5 or 6 years, like when that loan comes due again. And so I think luxury apartment buildings is going to get hit really, really hard when the economy does shift. And my idea is, hey, let me just keep on going buying B-class stuff. When the market shifts, then I'm going to be super liquid and I'm going to go buy that apartment building at a 10, 12, 15% cap rate for pennies on the dollar. And then I don't have to lease it out for $1,600 a month per unit. I can rent it for $1,000, $900 and still get the returns that I look for. And I have an asset that was built in 2016,
I agree with you, brother. I do. So I want to ask you a question here. If you've been doing this now, you said 2007 when you bought that first property, 2009 when you bought that duplex?
2009 was my first property, and I bought my first apartment building in 13.
So you've been at this altogether, at least from the investment side, for 9 years. Mm-hmm. If you can go back to year one, when you were just buying that duplex, you're the guy with the credit card trying to get that limit increased. Knowing what you know today, if you could give Tim some advice 9 years ago, what would that advice be? I
would have joined a mastermind earlier. By being involved in a mastermind, it just opens up so many doors. It opens up more opportunity. It opens up more access to capital. It opens up more wisdom of people that have already screwed up and messed up and gone through a bunch of the learning curves that you don't have to then go through. I joined a mastermind 3 years ago, and that's what catapulted my business and just opened up so many more opportunities. So that, and then I would figure out how these two skills are the two skills that I would develop: how to find deals, not through brokers, like how to find off-market deals, how to be direct to the seller, how to be awesome, and just be an amazing deal finder. Because when the economy's hot, you're going to bring on a ton of value. Yeah. Number 2 is how to raise money. If you can find deals and raise money, you will be successful regardless of the economy and regardless of the market. And so, it's a lot more difficult to raise money 5 years ago than it is today. But it's a lot more difficult to find deals today than it was 5 years ago. Yep. And that cycle is going to continue to change. So as long as you're good and you keep on sharpening the axe on those two skill sets, and then again, plug into some mastermind groups, find a mentor, find somebody you can joint venture with on a project, so you don't have to go and get kicked in the nuts like I did for 8 years. Those would be the things that I did.
Yeah, you're speaking to the masterminds a little bit, and it'd be quite expensive. I know the one that you and I were just at together. That's $20,000 a year, and I know you're a member of multiple different masterminds, some that are very high price tags like that one. But at the end of the day, if you can just walk away with one takeaway, which this last meeting there was literally one thing I walked away with that I know will give me a massive ROI over the next 3 to 6 months, and so I'm very confident that I'm going to make 100 times that $20,000 annual membership on that one idea alone. And that's this thing meets 4 times a year for that $20,000. So if you can just get one idea, and if you can't get even one or more, then you're doing something wrong, right? You're in the wrong mastermind then. But just one idea that can increase the value of your business, that can help you make more money, then it's well worth it. I know you feel the same way. It's all about the ROI that you get from the mastermind group that you're a part of, or the relationships that you've built there, and multiple different factors of benefit come out of it. You mind sharing just the general idea of what you spend on an annual basis on masterminds? I think people need to realize there's an investment that has to be had on your side to get involved in these groups, to get around the rub elbows with the guys that are the high earners, right? The ones that are actually out there doing it, not the ones that are just putting up sponsored Facebook ads or chalking products, but the guys that are actually out there in the trenches making money. So give me an idea of what you spend on an annual basis, if you don't mind. Because I know it's a lot. I know it's a fairly big dollar amount that you invest in. You're investing yourself, right? It's continuing education.
Yeah. And you're using the right word. It's an investment. There's a return on this. I don't see it as a cost. I see it as an investment. If you're not either doing deals or having takeaways from this, then again, you're not using it the right way. You're going to have relationships that are created that one person you're going to make millions of dollars with, and we'll be able to joint venture on a deal and just just from developing this stuff. So yeah, I'm part of 5 different groups, and I spend about, not including travel and hotels and all that stuff, about $80,000 a year on masterminds.
Yeah,
so
that's awesome.
But again,
it only takes one idea out of all those.
It takes one idea.
I guarantee you get
my ROI
one, right?
is many times that. Like the one that we were part of, I joined 6 months ago. I've raised $1.2 million from people in that group in the past 6 months.
There you go.
It opens up so many doors.
$20,000 investment right there.
Oh, big time.
Yeah.
Big time.
Yeah.
So, and the investment isn't to get in. It's to keep low-level thinkers out. You know that there's a certain level of caliber of people that are going to be in that room, because it does cost $20,000 to be in there. And so it eliminates low-level conversations. It eliminates a lot of low-level thinkers and people that come from a scarcity mindset versus everybody who's in that room comes from an abundance mindset. We can do more deals together. Let's 1 + 1 = 3. It's powerful. It's just good to be around, like, especially being an entrepreneur, man. Like it can get lonely. We talk in dollars and decimals, and you're hanging out with people with a common past when you're back at home versus people who have a common future with you when you go to these mastermind groups. Yeah, it's powerful stuff. Like, it's friendships and relationships that are going to be there for the rest of my life.
Yep. I love that, man. So, Tim, we're going to wrap things up here. You've shared a lot of golden nuggets here today. I mean, a ton of them, man. I'm sitting here taking notes as we're chatting here. But if you had just one last final golden nugget of advice or wisdom that you could leave with our listeners today that may inspire and motivate them as they progress in their real estate investing career, what would that one last final golden nugget be, my friend?
It would be resourceful. When I got started in real estate, I didn't have money. I didn't have knowledge. I had a little bit of time. And people say, hey, listen, I can't get involved in real estate because I don't have the time. I don't have the money. I don't have that information, the knowledge on how to do this. If you are resourceful, you will find all those other resources. Like, resourcefulness is the ultimate resource. I heard Tony Robbins say that. I was like, man, that's a great.
That's good.
If you could figure out how to problem solve, how to critically think, and how to figure out a situation and overcome that situation, see opportunity versus the obstacle, man, it'll change your outlook on life and everything that comes at you. And when your building burns down, when a partnership goes awry, when a tenant steals or something happens, whatever, it's not going to take you down. You're going to say, hey, okay, no problem. That happens. Like, I'm used to having problems. Let me just figure out a way to get past that, problem solve, and critically think so that way this doesn't happen again. And, you take a look at the most successful people and the most powerful people in the entire world, a lot of politicians, CEOs. The reason that they're in those roles is because they're the best problem solvers in the entire world.
Yeah.
And so by looking at that reminded me that if I can learn how to solve a lot of problems, I can be wealthy, I can be powerful, I can have the relationships I want and everything else out of life, all the good stuff.
I love it, brother. I love it, man. This has been a lot of fun. Seriously, Tim, I really appreciate you coming on the show. I've been looking forward to having you here. And you dropped a lot of good information today. It's been absolutely incredible. I know all of our listeners are going to take a lot of value away from this. And for those that want to dig a little deeper into Tim and what he's doing up there in Cleveland, actually not just up there in Cleveland, you're doing this, in multiple different states across the country. He's got 2 websites you can go visit. The first one is his business website, which is CLEturnkey.com. And he also has an educational side of his business where he teaches other folks to do exactly what what we were talking about today, invest in commercial real estate and multifamily real estate. That website is commercialempire.com. And just real quick, Tim, give me a general idea of commercial empire. What exactly is that? And I guess that's the question. What is that? What do you do there? What kind of education do you offer?
A lot of people, again, get involved in real estate because they want the residual income, the passive income, and then they get stuck in the transactional phase of flipping houses and wholesaling and all that. And they think it's a little bit too complicated to get into commercial real estate just because it's some different verbiage. Instead of using a return on investment, they say cap rate. Instead of using ARV, they say stabilized value. It's not as complicated as you might think. And so I run my business at a 3rd grade level. If it's more complicated than 3rd grade, then I don't do it. And so because I've been able to simplify it so much, I think that's why I've had a lot of success and why my team's been able to, make that transition so easily. And so it's primarily high level residential real estate investors that end up coming out to my events that they're like, there's something more than being in the rat race of flipping houses.
Yeah.
And so, if you're looking for how to find off-market deals, that's what we focus on. I don't talk about working through brokers at all. How to manage these general contractors, how to create joint venture partnerships so that way you can do these heavy value add processes, how to mitigate your risks and put the right insurance in place and all the right safety nets to make sure when the market does shift, you have the right financing and all those things in place. So I simplify it. It's almost stupid how simple I make it. Like, I've only been doing it for about 6 months now, and I've had some awesome positive stories. There was one guy who came out in April who's got 245 units in the past 5 months. There's another guy who just bought a 60-unit building that came out in April. There's a girl who just contracted. She came out in August and contracted 2 apartment buildings already. Another guy came out in August and has a 70-unit under contract. So, sometimes it's cool. Like, it works for me. I think it'll work for other people. And so now we've passed that threshold, and other people are having a lot of success. And it really makes me feel good that they're able to, create that generational wealth, that legacy wealth that we all get involved in real estate for.
That's awesome, buddy. Well, I'm glad to hear that not only are you doing it for yourself, but you're also helping others. That's what it's all about, right? I mean, the rewards behind that is huge, and you're helping others, take care of their family, build wealth for their family, legacy wealth that will carry on for hopefully many generations. So, Tim, really appreciate you coming on, my friend, and I look forward to following your success. We'll have you back on hopefully in the future. And what we're going to do, actually, we're going to have you back on after you're done doing that 5 apartment rehab. Once you stabilize, we're going to do an update on that story, and then we'll also get some updates as to the other projects you're working on at that point in time. So we'll definitely look forward to having you back, my friend. But until then, you take care, okay?
Dude, thank you so much for having me, Kevin. You're making a difference, man. You're really providing a lot of value to a lot of people. So thank you for all you do.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.